Afternoon, everyone. Welcome to Harvard University Employees Credit Union Home Refinance and Heloc seminar today. My name is Dominique Velger. Also joining me is my colleague, Migdalia Gomez, AVP of Community Engagement. We are also partnering with Thrive. It's our financial wellness. And what Thrive really does is it gives you some free counseling and also is a great some workshops. And we also have different worksheets that you can kind of balance and do all of your different financial needs and see what matches up, what works for you. And we have different short videos and calculators online and different portals. So if you wanted to get some more information on Thrive, you can just go on huecu.org/thrive. Of course, we have some house cleaning to do. Well, today's webinar is also going to be, we're going to mute you. So any background noise that you have a dog or a child crying in the background, we won't be able to hear them. So it's perfectly fine. And also use the Q&A feature if you have any questions, just to let us know what we can do, and we'll answer those questions for you at the end. And we also have some handouts and presentations that this presentation is going to be recorded, so you can watch it on our YouTube channel. And we have a survey at the end, so you can just tell us what we're doing, how well we're doing, and we can also try to improve and make it better for next time. So what is the credit union? So what we do here at HUECU, we serve all of the Harvard community and all of Harvard's affiliates. And of course, once you're a member for life, even if you leave the job. And we also extend that membership to any of your family members if they wanted to be part of the credit union, if it's your child, a spouse, a grandparent. We really try to connect families to become members of our credit union. We offer a bunch of different services and different products that will definitely help you just to make sure that you are a happy customer, that you have any kind of different needs, such as maybe student loans, or if you want to refinance, if you wanted to get a loan for your home, if you're thinking about buying a boat, we can also help you with that as well. Now, we're accessible everywhere. We have mobile banking. We also have Apple Pay, as well as different networks and different branches throughout the city, Massachusetts, and also to help you just to facilitate things and make things easier for you. If you can't get to one place, you can definitely find us elsewhere. Well, today's presenter is Ryan Douglas. He is one of our MLOs, as well as Mike Levine, and they are going to talk to you about all the different things that you need that will be able to help you. Gentlemen, you guys have the floor. So while we wait for them to get on, we just wanted to talk to you about some of the things that on today's agenda. We're going to talk about different options once you own a home, refinancing your home if you need a better rate. Of course, HELOC, home equity line of credit, how to use the equity that you already have, and what are the next steps that you need to take to save some money.
Hi, everybody. Ryan Douglas speaking here. Sorry about that. We were having some technical difficulties. So what are the options for refinancing? You own your home, now what? There's several things you can do. You could take no action. You can make accelerated payments. You could borrow against your equities with a HELOC or fixed second mortgage, or you could change the terms of the loan for a refinance, or you can also do a reverse mortgage. Next slide, please.
Okay.
Dominique.
All right. Good afternoon, everybody. My name is Mike Levine. The first area I'm going to talk about is refinancing. Once you buy a home, one thing I like to mention to people, when you buy a home, not only are you buying a place to live, but you should also look at your house as an asset. That's something that will provide use in the future. And that's where, refinancing can come into play. Many people, once they move into their home, they may just continue making their payments until, they pay off their loan or until they eventually sell the loan. But some people may decide to refinance their mortgage. And what is refinancing? Refinancing is basically taking out a new mortgage to replace the one that you already have. And the reason you would do it, there are a number of reasons you might do it: to get a lower interest rate, and as you see here, to reduce your monthly payment. Everybody is always looking to pay as little as possible, for good reason. So, oftentimes people, are constantly watching the interest rates. And sometimes you'll determine, well, the rates have come down 0.5%. Does it make sense for me to refinance, and save some money? But again, the primary motivation would be to lower your payment. Some other reasons for refinancing, as it says here, to reduce the term of your loan or even extend it. Probably, I'd say 90%, maybe more of the loans we see of people buying a home, they take a 30-year mortgage. There may be situations where somebody takes a 30-year mortgage, obviously to have a, low payment. Maybe, years later, their circumstances change and they can afford to pay a lot more. They might decide, well, I'm 5 years into a 30-year mortgage. I'm going to refinance, go to 15 years. I'll get a much lower interest rate, and my mortgage will get paid off sooner, and it'll help you establish the equity in your home sooner. The other option it shows here, which is not as common, is if somebody wants to extend the term. And, that might be, the opposite. Let's say you take out a 30-year mortgage, a 15-year mortgage. You're comfortable making that payment for 15 on a 15-year loan. Maybe your financial situation changes. You had to change jobs. Your income is less. Maybe you were relying on overtime and that went away. And you need to reduce your monthly payment. That might be a situation where somebody goes from a 15-year loan to a 30-year loan. But typically, most of the refinancing we see is, to reduce the term, or the next option where it says borrow additional funds for major expenses. This is what I referred to earlier, is using your home, as an asset, where you can borrow against the home, take out additional funds, for a number of purposes, which I'll get into in a minute. Another one, which isn't, that as common, is to remove the mortgage insurance, or PMI. So maybe you bought your house with less than 20% down. You had to take out the mortgage insurance. Between you paying down the mortgage and the property value going up, you may feel that you have enough equity to have the mortgage insurance removed. And sometimes you can refinance if you have enough equity. You can get the mortgage insurance removed. Okay, so the options for refinancing is a cash out refinance, which I'm going to get into these in a minute, a rate and term refinance, and one that kind of encompasses both the cash out and the rate and term. All right, the cash out refinance, and I love that kitchen here. I'm jealous. But the cash out refinance, you could borrow against your home, take out, additional funds, for basically whatever purpose. So in effect, what you would be doing is increasing the amount of your mortgage. So, let's say hypothetically, you've got a $200,000 mortgage and you need $50,000 for home improvements, you would take out a new mortgage for 250. Out of that 250, they'd pay off your existing mortgage, and then you would walk away with $50,000. And typically that's where you see people doing home improvements. You put addition on your house, things like that, upgrade. That's probably the most common use of cash out of a cash out refinance. People might do it, for a wedding. We see quite a bit college tuition. I don't have to tell anybody how expensive college tuition is these days. So we see a lot of that as well. People borrowing to pay for their children's college tuition. Some people may need it, may run into circumstances where they need to pay medical expenses. Another one which you see referred to as a rainy day fund. Some people may want to just have money to put away somewhere, just in case of they run into some circumstances where they might have an emergency and need to put money into the home. Tax considerations, if for whatever reason you end up having to pay quite a bit in income taxes and aren't able to work out anything with the IRS, that's an option where you can use a home for that as well. And another one is if you wanted to purchase a second home, you can use your house, your property for that reason as well. As I said, it's pretty much any purpose. We're not going to require proof of how you're using the funds. When you're borrowing against your property and doing the cash out refinance, the loan amount can't be more than 80%. We can go up to 80% of the value of your property. So you see here an example of a property appraising for $650,000. Take 80% of that is the $520,000. So that would be the maximum amount that somebody could borrow against their house. The second column is something Ryan will be talking about in a few minutes that's more applicable when it comes to the home equity loans. Okay, so the rate and term finance refinance, again, that would be separate, different than somebody looking to get cash out. I mean, this could be somebody that's strictly looking to lower their interest rate and obviously their monthly payment. So, maybe they've got an interest rate of 4.5%, and interest rates are down to 3.5%, and they've determined that they can lower their payment by maybe $75 a month or something, whatever the amount is, and they want to take advantage of the lower interest rate. Unfortunately, recently interest rates have been going up, but when interest rates are low, it's very, very common for people to be refinancing their mortgages and save money on their monthly payment. Okay, now should you refinance? I mean, there's a few things you want to look at. When you're lowering your monthly payment, you you want to make sure that it's going to be enough to make it worthwhile. Let's suppose you refinance and lower your rate by 0.5%. You want to look at how much you're saving on your monthly payment. In this slide here, they're showing you an example. I'm going to go to the middle column for a minute. It's showing the annual savings of $960, which would be a situation where somebody is saving $80 a month. One person might look at that and say, well, $80, that's a lot of money. I want to do it. Someone else might say, well, it's not that big a deal. It's not worth it. What you also have to look at is where it shows that first column labeled upfront lender fee. Those are the closing costs. So just like when you bought your home, you had to pay closing costs, you're gonna pay closing costs again, on the refinance. So you have to figure out, after paying closing costs, is it worth your while to do the refinance? So in this example, we're showing the annual savings of $960, the closing costs of $2,500. It takes just roughly 2.5 years to make the money back. So, in a case like that, I think, a lot of people would probably think, that it's worth it. Now, when you're, trying to decide whether you want to refinance, you probably, there's all these scenarios that you can go through your mind. Okay, well, what would my payment be if I drop it by, a 0.5%, if I drop it a full percent, what would my new payment be? If you go to the credit union's website, you see the link here, huecu.org /calculators. You can go online to our website and, plug in different scenarios, and, it'll show you, what your monthly payment will be based on different circumstances, a rate of, whatever rate you plug in, or, based on, the number of years. It gives, you can use all different scenarios to get that information. And also don't forget that any of the originators, myself, Ryan, and our coworkers, we're always available to help you with that as well. Should you reduce or increase the term? A lot of cases, there really is no right or wrong, with these things. And, what I tell people is, whatever you think is best for you. It's really not the type of thing where it's, black and white. Yes, you should. No, you shouldn't. Now, reducing the term is, like example, somebody takes out a 30-year mortgage. Maybe 5 years later, they decide that they can afford to pay more. They take out a 15-year loan. That example, they're saving themselves 10 years worth of mortgage payments, and obviously saving quite a bit in interest. And then by paying off the loan earlier, they're going to build up more equity in the property. And typically for a lower term, 15 years, you're going to get a more favorable interest rate than for a 30-year loan. Another thing to consider with reducing terms, it may align better with somebody's financial goals. Maybe somebody is, maybe in the early 50s, and they're thinking, well, I got to start thinking about retirement. I like to have my house paid off, by the time I retire. So maybe by shortening the term, they can get the loan paid off sooner and just be in a better position financially when retirement comes. Increasing the term, we don't see that very often. And I think I touched on that a few minutes ago. That might be a case where somebody has a 15-year loan, or for whatever reason, they need to reduce their monthly payment. Maybe a refinance to a lower interest rate might help slightly, but maybe going from a 15-year loan to a 30 is going to reduce their payment quite a bit and put them in a much better position. And there could have been financial circumstances that came up that put them in a place to need to do that. But again, there is no right or wrong. One thing that I mentioned, the closing costs before, and determining whether it's worth your while. Another thing you have to think about is, let's suppose you do a 30-year loan, you're 5 years into it, you go back to doing another 30-year loan. You may be in a good position as far as, saving your monthly payment, but you're adding another 5 years of monthly payments. So, that's another thing to keep in mind. And it's just really a matter of whatever your priority is. Some people that might be a big deal. Other people might not even care. They're just concerned about the monthly payment. So it's really whatever, works best for the individual.
Hello, everybody. We're going to go over the HELOCs and fixed rate second mortgages that HUECU offers. A few upfront benefits of these two products that we offer are that a refinance of the first mortgage is not required. You can have it simultaneously with your current mortgage that you have. And there's no upfront fees for HUECU borrowers. One thing to note on that is for if the applied for loan or line amount is $250,000 or less. If it is over that amount, you are required to pay for a full appraisal. So you would be subject to that fee upfront. What is a HELOC? A HELOC, or a home equity line of credit, is a financial product that's secured by your home. Typically, they're going to be variable rate mortgage products that can be used to pay for large or small expenses. And they factor very similar to a credit card. A few advantages of a HELOC is that it has a lower rate than other personal loans that are available out there or other types of lending. Disadvantages, the payment may increase if the interest rate does increase. Since it is a variable rate product, the rate is going to be based on the prime rate minus a discount of 0.26%. And that's how we'll calculate that, the rate that you'll be paying. How does a HELOC work? You are able to access the funds during this draw period, which is the first 10 years. You're able to borrow the maximum limit established at the closing, or you can use it for the entirety of this 10-year period. And as you do repay, the available credit limit is replenished. Following this 10-year draw period, it's going to end, and then the repayment period is going to begin. HUECU offers it's a 10-year draw period with a 15-year repay period on our home equity lines of credit. We also offer fixed rate second mortgages. These allow you to borrow the full amount at closing at a fixed rate and term. So unlike the line of credit, you're going to be able to access a lump sum of the funds. We have all different terms ranging from 5 to 20 years with a few stops in between there. So they're typically, the shorter the term on the fixed rate, the lower the rate you will receive. Advantages with these, there's a peace of mind that people do like, because you're going to be locked in at this fixed rate and term for the entirety of the loan. One disadvantage, though, as compared to the home equity line of credit, there is not going to be any flexibility to borrow against this. So the lump sum is going to be dispersed to you at closing, and the payments are going to start instantly the following month, and that will be the only amount of funds you'll be able to access. We're here to help, so please reach out to any of the 5 of us. There's 5 MLOs at HUECU. All of our emails are there. You can go to our website. You can schedule a call with us if you have any questions about what we went over today, first mortgages, second mortgages, refinance, anything. Please feel free to reach out. We are here to help at all different areas at the Harvard community.
You so much, Mike and Ryan. We really appreciate it. Of course, just a reminder, HUECU services and products, you can just, if you wanted to know more information, we just have an array of different mortgage products and, of course, different services for all of your needs. You can visit us at huecu.org/home-loans, and you can gather a lot of different information that would be very useful to you. And also, we have a survey at the end, just a reminder. Just let us know how we're doing. Any of the surveys, we can go on the huecu.org/survey, and you can take that survey. Also, just wanted to let you know that, of course, this presentation just giving you just a general overview of some of the different principles that you could consider. And of course, you have to decide what works best for you. And this presentation really is just a educational key just to kind of get you going, giving you some just really some generic information. We're not tax or legal or investment advice. We're just kind of just giving you some consultation from our certified advisors and just to give you different situation. Of course, you have to talk to your different advisors to see what will work for you and your personal needs and what will work for your financial needs as well. And of course, keep in touch with us. You can visit us at huecu.org. And we are located, our main office is on 104 Mount Auburn Street in Cambridge. And if you have any needs, we can definitely help to meet those needs as well.